Hello, welcome to Kopi Time, a podcast series on markets and economies from DVS Group Research. I'm Taimur Baig, Chief Economist, back from my summer break, and welcoming you to our 157th episode. Today, I'm really happy to have with us on this podcast our former colleague and longtime friend, Torsten Slok, Chief Economist at Apollo Global Management. Torsten has been with Apollo since 2020, prior to which he was with Deutsche Bank, and prior to that in the International Monetary Fund. Torsten, so good to have you on Kopi Time.
Thanks so much for having Taimur, and congratulations. 157 episodes. It's a huge landmark institution you have created here. So thank you so much for having me. I look forward to our conversation.
Thanks, Torsten. It's a shame that I haven't had you earlier, but better late than never. I'm so glad you're on. Torsten, as I said to you before this call started, we will mostly talk about the U.S. today. So let's just get going. Current state of the U.S. economy seems pretty resilient. So where do you see growth and inflation heading, taking into account trade war, fiscal legislation that just passed, and the immigration actions that the Trump administration is taking?
Yeah. So the summary is that the market is expecting, and we are expecting, and the Fed is expecting what I would call a Nike swoosh outlook. And a Nike swoosh outlook means that growth is going to slow down over the next several quarters. And when growth is slowing down over the next several quarters, we should, of course, expect to see, therefore, some headwinds to growth in the near term. And the key issue, of course, is what are those headwinds? Well, those headwinds, exactly as you highlighted, number one is, of course, the trade war. When you raise tariffs, prices of things that are sold in stores will go up. I do understand inflation has not gone up quite as much as we thought, just all of us a few months ago, but inflation will eventually go up and sales will eventually go down. Why is that the case? Because at the moment, the US government is raising around $30 billion in revenue from tariffs. So if you annualize that, that's a little bit less than $400 billion a year. Someone is paying $400 billion to the US government. There is no free lunch. Either this is passed on to consumers through higher inflation, or this is paid by companies through lower earnings. So the first headwind we're facing in the economic outlook is the trade war. The pig is still coming through the python. The trade war is ultimately going to have negative consequences for growth and also upward pressure on inflation. The second thing that's also important for growth is immigration restrictions. The goal from the Trump administration at the moment is to deport around 3,000 people every single day. If you multiply that by 365, you get that the annual deportation will roughly be around 1 million. If you deport about 1 million people, and estimates from Pew and others estimate that's about 12 million illegal immigrants in the US. If you deport about 11 million people every year, and 3,000 a day, that of course will lower employment growth, that will lower labor supply. So that will also lower, therefore, GDP growth in the near term, because we can no longer create jobs, especially in the sectors where illegal immigrants work, namely construction, agriculture, leisure, and hospitality. So that's also a headwind, arguing for the Nike swoosh in growth going forward. And the third and final thing that's a headwind is a relatively new headwind that has only appeared in the last few months, and that is that student loan payments have restarted. So there was a moratorium, a pause on paying back your student loans after 2020 during the pandemic, and that pause ran out in May of 2025, meaning just a few months ago. So now if I'm not paying my student loans, then it will begin to impact my credit score. And if my credit score goes down, that means that I'm not able to buy a new car, buy a new house, buy a new washer and dryer. About 11 million people at the moment are not paying their student loans on time. So that's a significant amount of consumers that are now facing headwinds with a lower credit score. So this is also weighing on the consumer outlook. So in summary, and forgive the long answer here, we see headwinds coming from the trade war, we see headwinds coming from restrictions on immigration, and we see headwinds to growth coming from what's been happening, of course, with, at the same time, not only trade war and restrictions on immigrations, but also at the same time, everything has been going on with student loan payments restarting. So the conclusion is we expect growth to be lower. And at the same time, we also expect inflation to be higher. So in summary, in one sentence, we expect a stagflationary outlook with weaker growth and higher inflation.
So, Torsten, the market then is kind of getting it wrong. And by market, I mean when we see the equity market, which is sort of on an all-time high, when we look at guidance coming from companies, it is far less dire than I would have expected, to your point, that if it's going to be billions and billions of tariffs paid by U.S. companies at the import level, at the customs level, they should be guiding substantially lower earnings, but they're not. So where is the disconnect between sort of the data and the tautology of a trade war and the fact that there's broad complacency in the market right now?
Yeah, this is very important. So there is a very strong disconnect. I agree with what you're saying between what I just said, that the consensus expects growth to slow down. This is what you see from your ECFC go on Bloomberg. This is the Fed's forecast. This is also happens to be our forecast. So for that reason, you say, well, if growth is slowing down, why is the market going up? Well, I think the market is going up because sentiment is so strong, and we have not yet seen the negative consequences of the trade war. So the issue in markets is that people are saying, well, there was peak uncertainty on the trade war in April. There might have been peak uncertainty on geopolitical risk also over the last few months. So if peak uncertainty is behind us, then, well, maybe we should be trading stocks higher. Well, the risk now is, of course, that these headwinds that are coming in ahead of us will eventually begin to, and most likely in our view, this earnings season, slow down earnings growth over the next several weeks as we get into when the earnings come out from different companies, of course, in the US. So the bottom line to your question is, I think the sentiment is getting better relative to where we were a few months ago, but I still think that now those policies that were put in place, IMF style, well, now you see the consequences of those policies, and now we need to think about how do I quantify the impact of trade war, immigration restrictions, and student loan payments restarting. And that's where we worry about that those impacts are going to be negative. So that's why I still think the economic outlook from the Fed, and therefore also from the consensus and what we're saying, we should be where we put most weight on, rather than the backward-looking view of saying that we have peak uncertainty behind us.
So, Torsten, I want to spend quite a bit of time talking about the Fed with you. But before I go there, let's just stay with the economy just a little longer. Your sense of the job market. I'm looking at the monthly payrolls data. It seems like public sector employment, which I thought would be cratering, is actually doing pretty well. So help solve that conundrum. And also, has Trump's measures over the last 6 months led to any impact on the jobs on the goods side, or are we talking about jobs mostly on the services side?
Yeah, this is really, really important because the general narrative in markets is that the labor market is solid. We're still creating, in round numbers, 150,000 jobs every month, and we still have a relatively low unemployment rate. It ticked down to 4.1% in the month of June. So this gives you the impression that the labor market is still fine. But exactly as you're highlighting, underneath those numbers are some very important differences between mainly we have been creating government jobs in the last few months, and less so in private sector jobs. So private sector jobs were only 74,000 in the month of June. So that means that the private sector has definitely been seeing a slowdown in job growth. So yes, we should expect to see still going forward also the labor market weaken. One thing that's a little bit of a joker in this discussion is this issue of lowering the labor supply through restrictions on immigration. So if you remove people, of course, from the labor force, then, of course, that means that ultimately we have, therefore, a situation where there's less labor supply. So at the same time, labor demand declining, well, then we have a race where both supply of labor is declining because people are being deported, and at the same time, demand is slowing down. So that's why the unemployment rate may actually end up not going up much, but we still should expect to see job growth slow down. And that's exactly what we're seeing. Private sector job growth has been slowing down in the last 6-9 months. And that is what I think we should be paying most attention to. And why is that happening? Well, that's partly happening, to your point, exactly that the goods sector is beginning to see some slowdown. But the overarching reason also why this is happening is, of course, that the Fed raised rates in 2022. And interest rates have now been relatively high. In most people's estimates above our star for some time. That means that monetary policy is still crunching and weighing on the economy, and therefore slowing down job growth, and therefore slowing down growth. And that's why we should expect to see over the next several months, and that's what the consensus expects also, that non-farm payrolls continue to slow down. The consensus has it slowing to around 60,000 here in the third quarter. So that means that growth in employment should begin to continue to weaken, but it begins to become more clear in the data that the headwinds to the economy are beginning to have an impact. So the other way of looking at that is that in the Nike swoosh outlook here, we are still not seeing a recession. But of course, the fear is that if you have a Nike swoosh, you don't want to have the bottom go below zero where you get a recession. So that's why the short answer to your question is the consensus still expects, still where we sit today, 35% chance of a recession in the next 12 months. That's not our forecast. That doesn't seem to be the Fed's forecast either. But we're watching very carefully when you have a slowdown for the risk, of course, that we do get a recession.
Okay, a little bit of, then backward-looking analysis then, Torsten, which is that we could have said the same thing 12 months ago, that a slowdown is coming, the Fed rate cut is going to be delayed, but the Fed went ahead and cut anyway in 2023, 4, and then we are again beginning to price in rate cuts coming in the second half of this year. So the backward-looking question is this: so why did we get 2023 wrong when the 2022 rate cuts, in theory, should have led to a sharp slowdown?
Yeah, this is very, very important. So everyone expected, literally, there was a dramatic consensus across every forecaster that when the Fed began to raise rates in 2022, everyone expected the economy to slow down. And there was so much conversation. You and I also talked about this at the time. Everyone expects a recession coming because normally when the Fed raises interest rates, of course, it results ultimately in a slowdown. So why didn't we get that sharp slowdown when the Fed raised interest rates so quickly in 2022 and 23? Well, the main reason for that are two things, namely there were tailwinds to growth coming from AI capex investment, and there was also tailwinds coming from government spending. So in the last 2 years of the Biden administration, government spending was very strong, and a significant growth in employment in the government sector was therefore accounting for why the economy kept on doing so well. So on the one hand, the Fed was raising rates, meaning monetary policy was tightening, and at the same time, fiscal policy was easing, pulling in the other direction, saying no, growth should not be slowing down when we have this significant government spending. What was the significant government spending? It was the CHIPS Act, spending on semiconductor production and building chips facilities in the US. And it was the Inflation Reduction Act that also created a lot of demand for manufacturing capacity, especially in renewables, solar panels, windmills, EVs, batteries, and all those things, of course, created also a lift in the economy. So that meant that we came into the election of Trump here with a fairly strong economy that had now faced some tailwinds coming from, of course, the AI spending and government spending. And now, of course, Trump put in place some policies and this is not a political discussion, this is just discussing what are the consequences of what different politicians do. But Trump put in place some policies, namely trade war, immigration restrictions, and those things, of course, including, for that matter, even the dollar going down. Those things, of course, have had some macroeconomic impacts. And it just happens to be the case that the trade war he has said them himself, Scott Bessent has said this, that we should expect a detox, we should expect an adjustment period. So that's why we came from a relatively solid economy, and then some policies were put in place that have some adjustments over time, and that's the adjustment that most people probably have in mind when they think about the Nike swoosh of growth being weaker over the next several quarters. So the answer to your question is there were some very unique tailwinds to growth, namely AI spending and government spending in 2023 and 24, that made it the case that we did not have that slowdown that your textbook would have predicted when you normally see the Fed raise interest rates as quickly as they did.
Indeed. All right. So let's touch on that AI spending for a second. Are we seeing any evidence in the labor market that all this spending is leading to an improvement in productivity?
There's a number of very important aspects of that very critical question. So at this point, productivity has been going up a bit, but the simplest way I look at this is to look at the unemployment rate. Well, the unemployment rate just went down. I mean, if productivity gains were going to make all of us unemployed, then, of course, the unemployment rate should be going up. So that means that one conclusion is that maybe the AI boom is still in the early stage of all of us figuring out how do we use Perplexity, how do we use ChatGPT, how can these tools be helpful for all of us. I know we have so many anecdotes of doctors using, of course, AI, lawyers using AI, financial services firms like DBS and Apollo using AI. But all those things, of course, are still very early. So we have not quite yet seen that dramatic boom in productivity or total factor productivity or even labor productivity that some people would have argued. So the short answer to your question is we are just not quite seeing it yet. And for that reason, then there's still a very, very open debate around, well, what is this going to do? Is this going to be this dramatic change in productivity? Or is this just going to be the constant technological evolution that we've been on for the last 20, 30 years? And that's the debate that, of course, is in the market at the moment, that some people think that the Magnificent Seven should be valued much higher than where they are today. And other people, including me, think that they are a little bit overvalued. This AI will make a big difference in our lives. But that's a different discussion from talking about what is the valuation of NVIDIA and Meta and Apple and Amazon, etc. So for that reason, the market is still intensely debating your question, namely, given we haven't quite seen that yet, well, what is the pace? How quickly is it going to come? And the last footnote on that, of course, the CBO just published a piece where they said, well, let's now assume we have an AI scenario where productivity growth is 0.5 percentage point higher every year for the next 30 years. Well, if that's the case, then actually the fiscal situation will begin to roll over. In other words, it is not only about you and me and large language models and what this can do for us in terms of productivity. It's also going to have a dramatic impact on the fiscal situation if we do have significant benefits coming because of AI, because then maybe the fiscal problems could disappear literally from one day to the other if we suddenly just simply have higher growth. So that's why this question you're asking is so extremely important for so many reasons at the moment.
Wow, Torsten, you said that with a straight face. I'm very impressed. The last bit, at least. I said that earlier that we're going to talk about the Fed a lot. Trump versus Powell. We're having this discussion in the third week of July 2025. In a month's time, 2 months' time, would Jay Powell still be the Fed chair?
So you and I worked together and had a lot of fun at the IMF. And the first thing you learn at the IMF when you and I walked in the door in the 1990s is that the central bank has to be independent. This is really, really important. So I still think that this debate around whether Jay Powell will be fired and who will replace him, I still think this is something that the market is not putting enough weight on, because the risks are, of course, that if the Fed is no longer perceived by markets as independent, then it does raise all kinds of similarities and worries about that this is then maybe not too different from Turkey, Argentina, South Africa, various countries where the central banks are not as independent as they are in the US and the ECB, Bank of England, of course, Bank of Canada, RBA. So for that reason, yes, this is something that I do think is very important. I still think at this point, the latest discussion where we are recording here is that Scott Bessent has been arguing also that they do not want to fire Jay Powell, and Trump also said that they do not want to fire Jay Powell at this point. But it's obvious that this is indeed something that's getting some attention. And for every time a headline comes through your Bloomberg screen about letting the Fed chair go, of course, the dollar goes down a little bit more. So the worry here is that the more the dollar goes down, we know from the Fed's model, when the dollar goes down 10%, the US inflation goes up 0.3%. So the more downward pressure there is on the dollar, it does begin to have some similarities with what you see and hear in emerging markets when you have the problem that the credibility of the central bank starts to get hurt, then the exchange rate goes down and long rates start to go up. And that's exactly been the response we've seen on several occasions here as this discussion has popped up. So the conclusion to your question is, I still think the Fed, and most importantly, the way the institution is built and the way the design of the institution is still very solid against the political pressure. Not only, we also saw that under Biden, various politicians from the Democratic side have also been putting pressure on Jay Powell. But the bottom line here is there are 12 voters on the FOMC. The Fed chair is one of those voters. So if the Fed chair comes in and a new Fed chair comes in and say, I want to lower interest rates, but if the 11 other voters say, we don't want to lower interest rates, well, then it's 11 versus 1. And then you have the outcome is by the vote that interest rates will not be going down. So the institutional setup is also done in a way where the Fed chair has at least a significant amount of power, but not significant and veto power or monetary policy decisions. And the very last point on this is, and I know this is a little bit a fine point, but it is very important that the president appoints the chair of the board of governors. But the chair of the FOMC is normally the same person. But the chair of the FOMC is elected among the FOMC members. So they could have at the first FOMC meeting that they elect someone else. So this is why there is, of course, a lot of discussion around, well, what if the chair of the board of governors is not the same as the chair of the FOMC? So there's a lot of, I know my head starts spinning sometime when you think about the consequences of all this, but there's just a lot of nuances that do become important, that the institution is able to function despite at various political pressures, both under Biden and also under Trump.
Is there any point to even trying to guess who's going to be the Fed chair, or do we just leave it to Trump to decide one day?
So you and I have also talked about that. Last time we met, you and I was in wonderful Copenhagen.
That's right.
So I mean, I look at this when we talked about it last time. It's still the same names that everyone talks about. So Scott Bessent, Chris Waller, Kevin Hassett, Kevin Walsh. Could also be Mickey Bowman. All those names, if you ask me personally, I still think they will be great Fed chairs. I still think the market will probably give whoever it is the benefit of the doubt. And then the clock starts ticking what is this person saying? How are they behaving? Are they firing people inside the Fed system? Are they hiring new people inside the Fed system? What are they saying in speeches? That's when we will begin to figure out, is this new Fed chair going to follow the dual mandate that is given by Congress? Or are they going to follow the dual mandate but put more weight on lowering interest rates and put more weight on growth and less weight on inflation? So that, of course, becomes an intellectual discussion around, well, how much weight do I put on inflation potentially going up? Should I say that's not a big deal? Goods inflation has here in the last few months started to move higher. You've seen inflation on tariff impacted parts of the CPI. So this is toys, furniture, tools, everything that is impacted by tariffs has started to move higher. So in that environment, it becomes more difficult for the Fed to cut rates unless you begin to say, we're no longer focusing on that. Now we focus just on growth slowing down. So that's why it all becomes a big challenge of that the Fed has a dual mandate, which is very different. The ECB only has one mandate, namely inflation. Same thing, Bank of Canada only focus on inflation. Reserve Bank of Australia only focus on inflation. The Fed focuses on two things, inflation at 2% and full employment. So that's why it gives some flexibility to whoever is the Fed chair. Should I focus on 2% inflation? Should I focus on the employment side of the mandate? And that's why the new Fed chair, once the speeches begin to come out, will begin to signal, and we have to figure out where is the weight being given in that conversation about what will the Fed do, and will they therefore will the new Fed chair begin to push harder for rate cuts coming?
So, Torsten, let's think about a scenario 12 months from now where the CBO's AI miracle has not yet arrived. So we're still talking about conventional growth rates and a very large fiscal burden. What's the chance of the next Fed chair and the next Treasury Secretary or the current Treasury Secretary beginning to coordinate and force some degree of financial repression down the throat of the U.S. economy?
Yeah, so because exactly as you're highlighting, and this is also page 1 in your and my IMF textbook, that if you both have that debt levels just keep going up, and at the same time now there is some pressure on the central bank to lower interest rates because we don't like to pay higher debt servicing costs, of course, that begins to mean that the central bank is beginning to prioritize other things than inflation. And when you have those scenarios, of course, markets begin to worry about, maybe tips and break-even should trade higher. Maybe worries about inflation should be higher, simply because now the focus of the central bank seems to be other things, namely debt levels, other things, namely debt servicing costs. So under those scenarios, of course, I think markets will begin to pay a lot more attention to especially the pricing of tips and break-evens and inflation, because in that case, you, of course, begin to have the risk scenario that interest rates could be cut dramatically in the front end of the yield curve. And yes, that would lower debt servicing costs. But if that comes at the same time with a significant risk of inflation moving higher, then, of course, it will ultimately be a very difficult trade-off in the political discussion of how do we manage that we have a growing high debt level, while at the same time we also have of course, that we don't want to have inflation to get out of control. So yes, you are right. This is highlighting the tension that is coming at a time when you have that, of course, debt levels are very high, while at the same time, inflation is unfortunately still not at the Fed's 2% target.
Would you put QE on the realms of possibility? Would you put increasing bank requirement to hold bonds as a possibility?
Yeah, so I do think that those things become very important. So SLR relief, so supplemental leverage ratio, is basically the tool that the government has, which has been relatively steady for now some time, but where they essentially can give the banks more capacity to buy treasuries. So if you get some relief on the supplemental leverage ratio, then that allows the banks to buy more treasuries. And if that's the case, you get some more demand for treasury from that source. But you're right. QE could also be an option. I think QE will only be an option if there is really financial instability, because QE as a decision is also something that needs to be decided by the 12 voting FOMC members. The Fed chair, him or herself, cannot do QE without the other FOMC members. They do meet and decide to say, let's buy the long end of the yield curve. So that's why yield curve control, various discussions and rates markets around what will the Fed do, is also something that's actually quite difficult to get through, because it does require all 12 FOMC members to vote on that topic. It could be a vote of 7 versus 5, which is really, really unusual. But just to say that for QE to come, I think we need financial instability in some form. I do not believe that they will do QE to bail out fiscal policy. A little bit similar to the ECB. The discussions there also is that they do not go out and buy Italian government bonds or Spanish or Irish or Portuguese government bonds for political reasons, but they normally only do it to, as they say, facilitate the transmission mechanism of monetary policy, meaning to keep the financial system stable and steady.
Now, the reason we're having this conversation is because there is a very large amount of issuance taking place on a regular basis, and there are some questions whether the market, U.S. market or global market, has the capacity to keep on absorbing such massive flows. So, Torsten, last November when the Fed had its last financial stability review, I noticed that there was this one part where they talked about this worry that off-the-run bond market liquidity is pretty poor. And so that sort of leads me to this question that you touched on, issues related to financial instability. We don't really think that's on the table, but we also worry about that, right? That it is a lot of issuance and the market's ability to absorb is a question mark.
Absolutely. So that is why, so the Congressional Budget Office, so today, let's keep the numbers very simple. Debt to GDP is 100%. And the Congressional Budget Office is forecasting that we're going to 130% over the next several decades. So that's going up quite significantly. So if that's the case, well, then if debt levels are going up, we need to issue more treasuries. So this raises the important question, where on the yield curve should the US Treasury issue more government bonds? Should it be 2-year rates, 5-year rates, 10-year rates, or 30-year rates? This becomes every government in the world thinks about this on a running basis every single day, namely where on the yield curve do we issue. And there's been a tradition in the US to say, well, we would like to keep the weighted average maturity of debt outstanding, meaning the maturity of all government bonds combined, at roughly 5 to 6 years. So now, of course, the risk is that if people are worried about lending money to the US government for 10 years, for 30 years, well, maybe now, and this is what Scott Besson has talked about more recently, maybe now there is more pressure to issue more in the front end. And that means in the front end of yield curve, meaning T-bills for stablecoin reasons, we could talk about that in a second, but also 2-year rates, 3-year rates, 5-year rates, because people are generally willing to buy shorter duration government debt, but less willing to buy 30 and 10-year government debt. That's, of course, now become important because what could be the sources of demand then in the front end of the yield curve? And one new source of demand, the Genius Act just went through Congress. What is the demand that could potentially come from stablecoins? And stablecoin demand at the moment, if you take Tether and Circle combined, they have T-bills of roughly around $140 billion. But if suddenly stablecoins become much more widespread used for transactions around the world. At the moment, 90% of the usage of stablecoins is for trading crypto. But if stablecoins suddenly become used for when I come and visit you in Singapore, I buy a cup of coffee from the coffee shop, and I use US dollar stablecoins to buy when you visit me in Copenhagen or here in New York, then you could also come and use stablecoin dollars to buy a cup of coffee or buy a meal, or we go out to a restaurant, or even buy a house or a car. If that's the case, global demand for US dollar stablecoins could go up. And there are estimates, and the TBAC has been discussing the Treasury Borrowing Advisory Committee. They meet once a quarter, and they've been discussing this, and there was a very recent debate, this is on the Treasury homepage, where there were estimates that this demand for stablecoins could go up into the trillions. And I know this is a bit special issue. You may ask, why do you and I as macroeconomists care about stablecoins? But the reason why this has become important is that if stablecoins suddenly become a means of payment around the world, not only in Singapore and New York and Copenhagen, but also in emerging markets where suddenly the financial system is more unstable and people would rather pay in dollars than pay in the local currency. That brings, of course, the risk that maybe demand for stablecoins and therefore for dollars around the world could grow significantly. And if that were the case, then, of course, a lot more T-bills, potentially into the trillions, could be purchased by the stablecoin issuer. So the short answer to your question is, there are some other issues than the AI story that can help our fiscal situation. The AI story will be a permanent solution, but the stablecoin solution will only be a temporary solution and not solve the underlying risk that we still have debt levels going up. But it is certainly a source of demand that continues to get a lot of attention and therefore, in my view, continues to be very important.
So I will have some degree of healthy skepticism about the ubiquity of stablecoins worldwide, Torsten, simply because I think that at a national government level, the seniority capability, the capital control capabilities are so paramount that most countries in the world do not allow for fettered movement of capital. I think the ultimate dream of the stablecoin crowd is that the world just becomes one that is frictionless, and we have just these wallets, doing transactions around the world. I think that governmental prerogatives might come in the way.
I agree. And let me also just add, our friends, some of you and my former colleagues who now work at the BIS in Basel, they just wrote about a month ago a paper that exactly highlighted, number one, exactly what you just said, that maybe governments will not allow payments in US dollar stablecoins. And that does make sense. You can begin to think about technologically, if you and I meet on the street in some country, I could buy something from you just by passing my iPhone to your iPhone. So maybe it could become a little bit more challenging for them to control. But absolutely, I agree with what you're saying. This is one very important reason why we may not see stablecoin grow into the dramatic size that some people are predicting. The second reason why this also, of course, is a risk is that let's not forget that stablecoins are issued by private companies. So that means that this is not issued like dollars by the Federal Reserve or a currency by central banks around the world. And if you suddenly have counterparty issues around a private player issuing a currency or issuing money, then of course immediately you begin to think about, well, what are the risks about this private issuer staying in business? Are there any issues around, could they be hacked by quantum computing? Could they be hacked by hackers from other countries? I mean, a lot of risk. And if they were hacked and suddenly you see that news, you could suddenly have a run on a stablecoin where everyone pulls their money out immediately, and then they would have to dump trillions, in the worst case, of T-bills on the market. And of course, if that's the case, that of course then comes with a risk that of course could create significant financial instability. And this was the BIS worry in that paper, say 3-4 weeks ago, namely that yes, we could have payment systems that are running and humming and everything is nice until suddenly there's risk around one stablecoin issue and everyone runs away like a bank run. Just like SVB, we saw a few years ago, a bank run where people pull all their money out of that stablecoin issue. And that could of course create global financial instability of significant proportions if that happened to be one very significant player in the stablecoin market. So yes, this is not, there is no free lunch as usual in economics here. This is something, of course, that can be helpful for demand for T-bills, but it does come with some financial stability risks.
Right. Torsten, I also worry a little bit about the governance side of the story because the U.S. government right now seems very pro-crypto, very, just go for the innovation, we'll figure out the guardrails later. Augustin Carstens, I had a conversation with him on this issue a few years ago, and he gave me this history of the Dutch East India Company's copper-backed stablecoins back in the 1600s and 1700s, which used to finance the maritime expansion of the Dutch Navy. And he said that those things lasted for a while. But then the governance, the underlying thing, you start sort of lying about how many do you have, because you think that, if I just manage to get another successful voyage, I'll replenish whatever copper that I'm lying about. And then at one point, even those things, the mighty Dutch Navy's copper-backed stablecoins sort of fell apart. And I hope that, history lessons are not particularly the strong suit of the Trump administration, but I hope somebody is still sort of, a bit worried about the governance aspect and does not lose their focus on that.
Yeah, because as you say, I mean, if you and I really lean back and think about it exactly as you just said, here we have privately issued money. And if privately issued money grows in significant size, then of course the systemic risks also grow. So that's why, as you're saying, governance issues around who are the issuers, how are they regulated, what are the risks, all kinds of things. And again, quantum computing, given some of the things that are going on, including with Bitcoin, there's just a lot of different things that can be risks that potentially could come along in different forms, which is exactly why, of course, now at the moment, we only have, or mainly have government issued money, namely Federal Reserve and ECB and Bank of Canada issuing money, etc.
Totally. Torsten, earlier in the conversation, you mentioned a little bit about investor sentiment being still fairly sanguine. I want to push on that, expand on that question a little bit. We have this whole story of, on one hand, stablecoin and all these things could boost dollar demand. On the other hand, all this trade war related stuff is making people nervous about holding the dollar to some extent. So among the investors that you talk to on a day-to-day basis, is there any sign at all of a desire to hold more non-US based assets, Europe, China, EM, and so on? What's your sense?
Yeah, this is a very important discussion. For the last 6 months, obviously, the dollar has gone down in trade-weighted terms around 10%. So, of course, this raises the question, why did the dollar go down? Well, if I at the same time, over the same period, look at the S&P 500, or IG spreads and high yield spreads, so the S&P 500 is close to all-time highs. IG spreads are super tight, high yield spreads are super tight. So one quick conclusion is it doesn't look like foreigners were selling US assets, because if foreigners were selling US assets, then the stock market would not have gone up. Remember, foreigners own about 20% of the S&P 500, foreigners own about 30% of treasuries, and foreigners own about 30% of the public credit market. So if foreigners really had decided to sell, then you would have expected to see not only the dollar go down, but also the stock market go down. And given we didn't see that, that tells me that the main reason why the dollar went down was probably hedging. And I think that the main reason why people were hedging was for two reasons, namely the trade war and, very importantly, Section 899 and the Mar-a-Lago Accord. There was initial discussion in the beginning of the Trump administration that we would have a Mar-a-Lago Accord where the rest of the world would be paying a fee for holding US dollar assets, and in return, the rest of the world would get protection through security. So this would be the Mar-a-Lago Accord. The US gives the rest of the world defense security, and the rest of the world in return pays a small fee. And Section 899, that temporarily was in the One Big Beautiful Bill, was an idea to put that idea into the world by saying, well, if you hold US treasuries in Singapore or in Europe or in Canada or Australia, then we can suddenly introduce a tax of 5 to 20% where we tax your cash flows on your US assets. And as a result of that, you will now have to pay a small fee for the security that we give you on the defense side. I know these things is a little bit arm wavy, the argument, but this was the conclusion and this was the debate. But Section 899, when that was in the One Big Beautiful Bill, it created a lot of downward pressure on the dollar. So in my opinion, now Section 899 is no longer part of the One Big Beautiful Bill. It was taken out. And at the same time, given the trade war, it looks like we have the August 1st deadline, and it looks like we're getting some more clarity, and maybe the trade war also looks better, at least in the next several months, if you take a longer lens. So with those two things behind us, namely Section 899 no longer being part of the conversation and Mar-a-Lago no longer being part of the conversation, and at the same time also here we have now that the trade war looks also we're getting closer to the end. Deals or no deals, we'll figure out, but at least closer to the end of that. I think all that will argue for less hedging needs, and if there's less hedging needs, that then tells me that the risks are now, and this is my view, that I think the dollar is actually about to go up. And this is also what you saw in the tick data. The tick data is the Treasury Department's data for what is the flows in and out of US different financial assets. So what's the flows in and out of the stock market, of treasuries, of credit markets. And you saw very significant slowdown in flows where basically you saw very little buying of US assets in the month of April. But the data that just came out for May saw a significant rebound where a lot of foreign investors basically started buying US assets, stocks, treasuries, credit. And for that reason, I am not so worried about that foreigners are running away from US assets. I think the latest data actually shows this risk that we should more worry about, the upside risk to the dollar for the next 6 months.
Okay, that is a fascinating point. I think that you are not in the majority in making that call, Torsten. So very interesting because everybody's out there, sort of writing the obituary of the dollar and how there is this marks a big structural shift. I think it's a premature obituary of the dollar, and we'll see particularly, interesting U.S. stocks remaining the most interesting and compelling cases around the world. Torsten, you and I can chat for the next 4 hours, but you have stuff to do. I don't want to keep you.
To come back again. Section 300.
Yeah, exactly. So again, thank you so much for your time and insights, Torsten. Really, really appreciate it.
Thank you.
Thanks to our listeners as well. Kopi Time was produced by Ken Delbridge at Spy Studios. Daisy Sharma and Violet Lee provided additional assistance. All 157 episodes of the podcast are available on YouTube, as well as on all major podcast platforms, including Apple, Google, and Spotify. This conversation was for information only, no investment advice, guys. And for our research material and webinars, you can find them all by Googling DBS Research Library. Have a great day.